What's the difference between an IUL and a whole life policy? I'll tell you. IUL, aka Indexed Universal Life, and whole life are both forms of permanent cash value life insurance policies, which means you buy a death benefit, you're going to have it the rest of your life as long as you follow the general rules and stuff around the product itself. Each one varies as far as those things go. Whole life tends to have a fixed premium structure. So what does that mean? It basically means that whatever you decide to pay for however long you decide to pay it, that is what you are doing. It's pretty rigid as far as the contributions go. If you want to do a two-pay, you can do a two-pay, which means pay for only 2 years. That's great if you have a lot of money. If you want to pay until you're 90 years old and you just say, I'm going to do $300 a month till I'm 90, cool. If you skip a payment or don't do that plan, you're going to lose the policy. If you ever decide you want to put in more after your allotted time, you can't. So that's it. It has a fixed earned interest rate, which means it's only going to earn whatever the insurance carrier declares that interest rate to be. And right now, whole life interest rates are anywhere from 3 to 4%. Not really the highest interest rate, not great for people who want to get a little bit more return on their money. My savings account's doing a 4.6. So personally, whole life isn't doing a lot for me right now. It has the cash value, right? It has the loan feature that allows you to take out these loans tax-free because of Internal Revenue Code Section 7702. All of those things are a part of the whole life, okay? The whole life, the other thing that's really beneficial about whole life is it is a guaranteed product, which means everything in it is guaranteed. All of the cash value, like you pretty much know exactly where it's going to be in 20 years, again, because of that fixed earned interest rate. The death benefit, all of it is guaranteed. There's nothing about it that's like, well, I don't know, it made me, there's no hypotheticals, right, in whole life. That's part of why a lot of people like it. But you can do the be your own bank concept with that, all the things, right? So that's basically whole life. It's pretty simple as far as, it still has to be structured properly in order to work if you want it to do the be your own bank idea, but that's whole life. IULs, okay? IULs mean Indexed Universal Life. It's a little bit more complicated in the sense that you're indexing, so the money you're putting in, the leftover premium that you're putting in is mirroring the market. So you have the benefit of the growth of the market without the risk of losing your funds because you have a 0% floor. So you're going to earn based off of market growth, not a fixed earned interest rate. The other thing about IULs is they have what are called guidelines. Guidelines are minimum and maximum contribution limits for your policy. Now, these are calculated per policy. They are not per person. They are based off of age and health and gender and what you're contributing and what your death benefit amount is. Your death benefit type even affects these numbers. So it's really important to work with an agent that understands these rules specifically. Because they are your limits, they are your rules for your policy. If you mess with them or if you don't understand them, your product's not going to work the way you want it to. Now, the idea behind using an IUL for cash value and that kind of same loan feature, the be your own bank concept, right, is to max fund it, which means you're hanging out next to your maximum contribution limit and not your minimum. Okay, that's the idea, is you're filling up the bucket. So the minimum is basically covering fees and the cost of the insurance. Everything left over gets to go into your account where it gets to earn interest from that market mirroring. So you have a lot of flexibility. You can increase your payments, decrease your payments. This, again, only happens if it is set up properly. If you have an agent that gives you a lot of death benefit in an IUL, even whole life, but in an IUL, like, you're going to make all of these numbers bigger. And if you're only paying down here, like, it just... You want an agent that understands this product. It's way more complicated, unfortunately, than just the whole life. Whole life, it's put your money in, how long do you want to put it in, you're going to earn, 3%. Done. That's it. IULs, here you have all this flexibility. You're in control of what you're putting into it. If you put in more, you get more. If you put in less, you get less. That's it. That's pretty much, but you want to make sure that you have the room to be able to do that because we all know life happens. If you need to decrease your payments, it's nice to have that flexibility, right? And if you've been max funding it for years and you decide to skip a year, you can absolutely do that. Like, there's a lot of flexibility with IULs, which is why, part of why so many people like them is because you do have the flexibility to put in as much as you want, drop it in. The only person it affects is you and your cash value accumulation. However, if your death benefit is too big, this goes for both products. If your death benefit is too big, or you work with an agent that didn't set it up correctly, which basically means giving you too much death benefit or adding a bunch of riders and all these things to the policy that they don't really need, unless it's whole life, it does need a paid up additions rider in order to work properly. But like riders make everything more expensive, which takes away from your cash value. Bigger death benefits make everything more expensive, which takes away from your cash value. So like, you want to work with an agent that understands both of these products and how they work. If we give you bigger death benefits, our commission is really, really good, and you're going to get a policy that probably doesn't work. But overall, those are the biggest differences between whole life and IULs. Couple things, whole life tends to have, their loan rates tend to be more expensive than their fixed earned interest rate, whereas IULs, you have different loan options you can choose from, and those rates are going to vary based off of insurance carrier and market things, and you have fixed rates and variables, and so again, way more flexibility in the IUL. The cons, I guess, to both these products, again, higher loan rates. The guarantees in a whole life also make the product more expensive just in general. Long term, the whole life is not going to have as much cash accumulation, just because, again, you're only earning a fixed earned interest rate, and it's based off of whatever you agreed to at the beginning. IUL cons, we can't guarantee any of the numbers we show you. That's part of why at Power 3 Financial, we illustrate so conservatively, right? We want to make sure that we're keeping expectations really low, because it should do better than what we're showing you. But again, we can't guarantee any of that. So we make sure that we're illustrating very conservatively, even showing our clients 3% returns in a column, things like that, to make sure that you understand, we can't guarantee, but we're going to make sure that we keep expectations super low. The other con to an IUL ultimately is if you work with an agent that does not know what they're doing. And full disclosure, most agents don't. Most agents are taught to sell death benefit, not cash accumulation. So they're almost always going to give you a larger death benefit than what you actually need for the IUL product to work. Yes, it is life insurance, but it's life insurance that we're using in a way that so that you can use it while you're alive. And you want to make sure you're working with an agent that understands how to set that up correctly. If they don't, it's not going to work. And this is part of why so many people think these products are a scam, because it's not the product that was wrong. It was the agent who set it up and didn't know what they were doing, or B, didn't care. And we never know which is which, right? We can't tell if the agent's uninformed or informed and taking advantage of that. So just make sure you work with agents. If they, on both products, if you work with an agent, you want to make sure they're going over the fees with you. With IULs, that going over the guidelines, showing you the cash value. If you ever see a 0 in the cash value column, whether whole life or IUL, that death benefit's too big, the product's not set up correctly. You don't want that. So make sure they're going through these illustrations with you. Make sure they're sending you illustrations after they've gone over them with you so that you can look over it and read the fine print, right? You should be going into this very informed about this product, and call me crazy, but you should understand what's happening with your money within the product before you sign anything. If you don't understand it, don't sign. Our goal at Power 3 Financial is to make sure that you are informed and educated and that you know what is happening within this product. And that goes to the fees, everything. Okay, we show you everything because we want you to make an informed decision, because a lot of people don't get that chance and end up getting screwed over. So I hope that answered some questions. This ended up being a longer video than I had intended for it to be. Have a great week, guys. Oh, and if you comments, questions, and if you want to talk to us, go click the link in my bio.